welcome all. My contact information is displayed. Brenda Kasuva is how you are able to connect with me online. Would like to thank you, Kyle, for making this possible today. And Kyle information is displayed. He's with First Home Mortgage. He's the one that's going to be sharing a lot of the products that you're going to hear about today.
As Brenda said, I'm Kyle Davidson. I'm with First Home Mortgage. My office is actually in Crofton area. I do a lot of business in both Prince George's County and Arundel County and all around Baltimore as well. So I'm very familiar with a lot of the programs. I'm going to share with you some programs that are location specific to specific counties. And I'm also going to share some programs that are, I guess, universal for all of Maryland and maybe not even specific to Maryland necessarily. You can use them if you are licensed in other states as well. This is kind of my specialty. My office does more loans with the Maryland Mortgage Program than any other office in Maryland. So we are very, very familiar with these programs. This is just a list of basically all the programs that they offer. They do have a couple more niche programs as well that they just added. I'll try to touch on those as well. But as far as these loans, what kind of sets us apart is that our processors work with these loans very, very often, and we're able to close them much faster than any other lenders are. So I just closed a loan on one of these where we were cleared to close in 23 days on one of the 5% loan programs, which would typically take up to 45 days is what you would typically see. We're now advertising we're able to close these in 30 days consistently, and we haven't had any challenges meeting that goal. Okay, so just gonna touch on a couple of these programs. The First Time Advantage 6,000, the 3%, the 4%, and the 5% loan. These all operate exactly the same way. They do have slightly higher interest rate as you go up in assistance. So the 5% loan will have a higher interest rate than the 3% or the 6,000. So typically people don't want to get the higher assistance unless they absolutely need it, because it's going to be reflected in their monthly payment. These are a 0% interest deferred loan. So basically that means that they are going to have to repay this loan at some point. Typically, you're going to see it repaid when you refinance or when you sell the property. If you do hold the loan to duration, the 30-year fixed mortgage, it will be tack on a few extra payments on the end of that as well. It is deferred for the life of the first mortgage. And you are able to combine it with other programs. So if you're in Baltimore City or Prince George's County, you would be able to combine this with programs such as like the First Time Homebuyer Programs in Baltimore or the Pathway to Purchase in Prince George's County. We do require a homebuyer education course, but this can actually be completed after the buyer goes under contract. This is why this is very popular program, because it doesn't require you to go out and get any certificates up front for your clients. They basically just take like a 2 to 3 hour course after they go under contract that just, it's very simple and it has a little exam, but typically people don't really have any problems with it. So, essentially what these programs do is they allow the buyer to get into the house for very little down. I just closed one of the First Time Advantage 5% loan products, and the buyer was able to get, I think, 2 or 3% in seller help as well. And he only needed, I think, $2,500 at the closing table. And that was the one we were able to get cleared to close in just 23 days. Everything was perfect about that one. His cash to close went down at closing. His payment went down significantly as well. But yeah, so I guess a lot of times these programs can actually alleviate the need for seller help by themselves, because when you're talking about a $300,000 loan, the 5% program will, allow them to get into the house typically for under $10,000 total out of pocket. And then if you need any more assistance, you can just ask for a little bit of seller help to get the closing costs down to where the seller needs to be. Or you could combine it with another program if the seller is willing to play game. Obviously, tacking on another program can extend the time of the closing a little bit. probably, I would say, if we're at 30 days for MMP, if you tack on another program, you're probably going to need to be at 45 days. The First Time Advantage Direct, I think this is probably one of the most slept on programs. I just used this today, actually. These are compatible with all the 4 major loan types. So you can use them with USDA, VA, conventional, and FHA. So I actually used this First Time Advantage Direct program with a USDA loan. The USDA loans today were hovering, in the 5.75% range, and the First Time Advantage Direct was actually a 4.75. So I was able to actually use this program to lock in my client, and it amounts to about $200 a month in savings. Now, the caveat to this program is that you can't be taking any assistance. You can combine this with another program, which I have done in the past. You could do it with a county-specific program, but you can't be using, the 3% loan. But it does have significantly lower interest rates than we're seeing in the market, at least for the government interest rates, so VA, FHA, and USDA. And in some cases, my company will actually provide a subsidy, and they won't even require us to go through MMP. So we still could potentially close in 21 days or less. So I've been utilizing this a lot for FHA buyers because the rates are just so much lower than what anyone else is seeing in the market. As I said, today they were at 4.75%. And all of their interest rates are actually posted on their website every day. So you can, if you just type in MMP interest rates in Google, you can get to their rate sheet relatively easily. And it also outlines all their programs. The Homestart program is very, very new. It's probably released about a month ago. It's by far probably the best program they offer, maybe outside of the Smart Buy program. Really, the difference with this program is that the income limits are a lot lower than the other programs. For the 3%, the 4%, and the 5% program, the income limits are actually pretty high, so a lot of people qualify for it. I think now they're over $120,000 for the household income in Anne Arundel, Baltimore counties. And then for Prince George's counties and like ones that are bordering DC, they're like really high. They're like 170,000. So a lot of people qualify for these programs. But with the Homestart program, they have to be below 50% AMI, which right now is about 58,000 in basically most of the counties in Maryland. It's in Baltimore. It says in Baltimore here. I think it's 70,000 in PG and Montgomery County. So this program is only for whoever's on the loan. Their household still has to be below the total MMP income limits. But when you're talking, in this case, the 50% AMI, only the person on the loan has to be below the $58,050. But what this program does, obviously, it gives you the 6% in assistance, which is more than any of the other ones. And it also has lower rates. Typically, the rates for this program are the same as the 3% loan, which are the lowest of the down payment assistance programs. So, it's I guess if you qualify for this program, you're typically going to want to take it if you need assistance.
So do you or they allow a floating rate option?
Yeah, so you can float their rate after you go under contract. Typically, we don't recommend this just because MMP's rates don't actually follow the market very well. Usually if they do follow the market, they're very delayed in doing so. But yeah, so I mean, it's really typically not worth the risk. I can't really remember the last time any of the program's rates have changed. It's probably been 3 months or so since the rates changed for the down payment assistance programs. The direct program, that one changes basically every day. The First Time Advantage direct program, that one does change slightly, but it's been fluctuating between like 4.75 and 5.25 for FHA. And Stephanie had asked me if these are for FHA only. These are actually for all the 4 major loan types. So you can do conventional. Conventional do have separate rates from all the other 3. For VA, which is for veterans, USDA, which is for rural, and then FHA, those will all have the same interest rate. Conventional typically does have a slightly higher interest rate with these programs. So yes, you can float, but it's typically not recommended because the downside typically outweighs the upside.
Thank you.
Of course, we do leave that up to the borrower in that case. The flex programs, they're very similar to the first-time advantage programs, except for these aren't for first-time homebuyers. You don't have to be a first-time homebuyer. I will say for all the previous programs, you can qualify for these first-time advantage programs even if they're not a first-time homebuyer, if it is in a targeted area. So all of Baltimore City is actually a targeted area. So all of anyone buying in Baltimore City would be eligible for these programs, even if they're just selling their house, this week. For people that are not in a targeted area, and you're also considered a first-time homebuyer if you haven't owned property in Maryland in the last 3 years. For people that are not a first-time homebuyer, say they just sold their house a year ago, they would be eligible for these programs. The Flex Direct, which does give you a little bit lower interest rates. It may or may not be worth it depending on the credit score of the buyer. It gives you a discounted interest rates and mortgage insurance. They give discounted mortgage insurance on all their conventional products, which is kind of an added bonus for these programs. And then they do offer the $6,000 and the 3% loan for these programs as well. But again, these rates are a little bit higher than you would see for the first-time advantage programs. The Smart Buy program that they offer is probably the program that I get the most inquiries about, although it's kind of rather difficult to qualify for because it's a very specific circumstance that makes sense to use this program. They do have slightly higher rates. But they did make a lot of improvements to this program that make it much more, it makes it much more usable and desirable, I would say. So obviously the key feature of this program is it's going to get rid of up to $30,000 in student loans. It does so, it actually drops off 20% each year for 5 years. So if you were to sell the house before 5 years, you would be on the hook for whatever hasn't been forgiven. If you live in the house for 3 years, you're still on the hook for 40% of whatever you had on your student loans. How they do so is they'll give you 15% of the home purchase price towards paying off your student loans. So you can't buy a $40,000 house and pay off $30,000 in student loans, unfortunately. Probably everybody would take advantage of that, but it has to be 15% of the home purchase price, and then it goes up to $30,000. So it's going to cap you at that $30,000 level. And then the key caveat is that all of the student loans must be paid off in order to qualify for this. So if you have $40,000 in student loans, you're going to have to bring that extra $10,000 in student loans to qualify for this program. So a lot of times, if your buyer doesn't have the assets to come up with the extra down payment or, to pay off the rest of their student loans, they're just not going to qualify for this program. And then a couple other key features that they just added is they just increased the down payment assistance from $5,000 to $6,000 for this program, or they'll give you the 4% in down payment assistance. That's 4% of the loan amount towards your down payment assistance. So typically a buyer will take whichever is higher of those two. Obviously, if it's a lower purchase price, the $6,000 could be more than the 4%. They do require you to put 5% down on this program, and they do have a 720 minimum credit score for this program. So the credit requirements are rather high for this program. I think I forgot to mention, but all of these programs do have a 640 credit score requirement. So the credit scores do go pretty low for these programs. They do want you to have a 660 credit score. But in certain cases, we can go down to that 640 if they have 2 months in reserves, and they do have to have other compensating factors like low other debts outside of the mortgage, things like that of that nature. But typically, we have no issues getting those exceptions approved to go down to the 640. So for the Smart Buy program, they are going to require you to take that homebuyer education as well. I guess the two major caveats that make people not qualify for this one typically is that 720 minimum credit score, and you have all the debts must be paid off at closing, all the student loans. So I guess I wanted to touch on a couple of the other niche programs that MMP is now offering as well. They do have a Montgomery County specific program as well. That program is giving a lot more assistance. If you are in Montgomery County, I won't touch on it too much because I don't know how many people are actually in Montgomery County, but if you do get a buyer in Montgomery County, if they qualify for that, they'll probably want to take that. So this is how you see their rates every day. They post here every single day. If you scroll down, you can see some of the more niche programs at the bottom. So you can see today the first time advantage 6,000. It's at a 6.75% interest rate for the conventional, and it's at a 6.25 for government. And then the program that I used was that 4.75, but again, that doesn't give any assistance towards closing costs. You scroll down all the way to the bottom.
So government, to be clear, is FHA and or VA, correct?
And USDA, which is rural, but you're not going to see a lot of rural loans in this area. If you go north to like Carroll County, you might see some rural, or like Frederick, or south to like Calvert County. So you can see the Smart Buy programs on the left there and the Montgomery County on the right. And then they also added the Homebuyer program, which is for households that are either taken care of or are disabled themselves. That actually gives up to 25% in assistance, the Homebuyer program. So it'll actually get rid of mortgage insurance if you are a conventional buyer. I guess you are required to be conventional for that program. For the Montgomery program, it gives you up to 40% of your household income, up to $25,000 in closing cost assistance. So essentially, those two programs can help you get into the house for basically nothing out of pocket, and they can even eat away a little bit at your principals to keep your monthly payment lower as well, especially so the Homebuyer program. Again, the Montgomery County program, the only caveat is you have to be buying in Montgomery County. For the Homebuyer, you need to be taking care of somebody on disability or yourself be on disability as a buyer. So those are kind of new programs. Those ones do run out of funding at some point. So it's kind of like a use it or lose it. I think last year they ran out sometime in the late fall. And they do renew typically every July. If you're in Baltimore, you may want to consider looking at some of their programs. I won't dwell too much on these programs themselves, but Baltimore City has a ton of great programs. This is probably the most common one is the first-time homebuyer incentive program. They'll give you up to $20,000. I think typically it's $10,000, but in certain areas they'll give you $20,000 towards your closing costs. I have a couple buyers using this program now, and this one, as opposed to MMP, is a forgivable loan. So it actually will be forgiven after you live in the house for 5 years. I guess one of the major reasons people would not use this program is that the income is capped at that 80% AMI. Right now, that's about $93,000 for most of Maryland. In the southern states near DC, it is a little bit higher. And you do have to be a first-time home buyer for this program and those other specifics. Live near your work. This is another program. The buyer's work has to be basically on board with this program, but basically the company will match, or the grant will match whatever the company is willing to put forward. That's why you see the spread in 2,000 to 5,000, and they are giving more in assistance now than the 5,000 for. I think it's Johns Hopkins in particular gives a lot more than the 5,000, so that figure is a little bit outdated. Vacants to Value program. This is a program that it has to be basically in the city's registry for a vacant property, but they'll give you a flat $10,000 in assistance. That Live Baltimore site has a ton of programs that you can look at. These are just kind of the most popular. If you are doing business in Baltimore City, these might be useful to you. The Vacants to Value is just for those vacant properties. They do have to be in the city's registry. Again, you have the 5-year forgivable loan, and the home must be vacant for at least a year to be eligible for that. And I guess the big things for this one is there is no income limit, and you're not required to be a first-time home buyer. You do have to live in all these properties as your primary residence. So you can't buy these as a flip or an investment property to be a rental. Those would not be eligible for these programs. These are only for owner-occupied properties. And for these 3 programs, I guess the biggest turnoff for these is you do have to take an 8-hour course before you're eligible for these. Brenda and I actually teach one of these courses, so we can easily help your clients get signed up for these. But they do have to commit to that 8-hour course before they can go put an offer in on the properties. They can't do it, after they get the offer accepted, unfortunately. Just a couple other programs that we offer. I'll just touch on these as well. The Chenoa program operates very similar to MMP. The Chenoa Fund is what it's called. They do have a couple different programs that they offer. They do have a repayable loan program, and then they do have a forgivable loan program. The difference is the forgivable loan does come with higher interest rates, so you're paying that back in your monthly payment. The repayable one has much more attractive interest rates, and it typically makes more sense to go with the repayable option. I guess the biggest benefactor of using Chenoa over MMP is that the guidelines are much more lenient. They'll allow you to purchase a duplex with this product. You have to live in it as your primary residence, but they'll allow you to purchase a duplex and kind of rent out the other side. I had a buyer do this in Baltimore City earlier this year. And they'll also allow the debt to income requirements to be higher than with the Maryland Mortgage Program. The Maryland Mortgage Program caps you typically at a 45% debt to income ratio for FHA buyers. Chenoa will allow you to go up to a 50% for FHA buyers. MMP will allow you to go up to a 50%, but the credit score has to be above the 680 limit. With Chenoa, you can go straight down to a 640. I think they may even allow down to a 620 now, and they'll allow you to go straight up to that 50% debt to income. So sometimes if somebody's right on the border with MMP, they could just go to Chenoa and use that program and have a very similar outcome as MMP, and not have all the headaches of it being just borderline qualifying. Pathway to Purchase is a Prince George's County specific program. It operates kind of similar to MMP. It'll give you assistance towards your closing costs, but that one's going to cap you at that 80% AMI, which I believe is over 100,000. I think it's like 112,000 in Prince George's County. So if you're operating in Prince George's County, that one might be worth looking into. I have had people combine Pathway to Purchase with the Maryland Mortgage Program and not need any money out of pocket. I guess the big drawback of Pathway to Purchase is they do require a 60-day close. So it's, you have to get the seller on board. I guess in some cases where the seller, wants to do a rent back or wants to live in the property for longer, that program could make sense. And then ACDS is the Anne Arundel County's program that's very similar to Pathway to Purchase. Basically all the same requirements. It's got the lower income limit as well, but that one will actually give you much more in down payment assistance as well. FHLB Community Partners product, FHLB does offer several programs, but this is probably the one that most people inquire about. It's for police officers, educators, healthcare workers, firefighters, and first responders. So they opened up their pool significantly by adding that first responders category. But they'll give you up to the $10,000 in assistance as well. And they'll give this to you as a 5-year forgivable loan. So obviously, if you're going to go with one of these programs and you qualify for a forgivable loan over a repayable loan, you're going to want to go with the forgivable loan because, after a while, you're not actually going to have to pay that back, and it's just going to be forgiven. This program doesn't require you to be a first-time home buyer. And again, your income is going to be capped at that 80% area median income. So these are really all the programs that I have. I could touch on a few other programs that are not necessarily down payment assistance programs that might be valuable to your clients.
So Kyle, I have a question. Could you talk about, so most of these, like you said, are available through FHA as well as conventional.
Yeah.
The FHA is a lower interest rate, but
Yes.
the conventional has only the private mortgage insurance until you've paid down 20% of the loan.
Yeah.
So can you discuss the negatives and positives of each of those?
Yeah, so I guess it's all of these are compatible with those with different programs. I guess the question is more in regards to the trade-off between FHA and conventional. And yes, so the interest rates with FHA are typically lower than what you see with conventional. But I guess it's not necessarily that always amounts to that being the best program for the buyer, because with FHA, you do have the upfront funding fee, the MIP funding fee, and they also have a monthly mortgage insurance premium. So those two, the upfront mortgage insurance premium is financed into the loan, whereas the monthly one, it will never drop off. With conventional, you don't have any upfront mortgage insurance premium, and you will also drop off your private mortgage insurance after you reach 20% equity in the property. Now, why people typically will choose to go with FHA is because they are much more lenient as far as their guidelines. They do allow up to a 57% debt to income ratio, whereas conventional is going to cap you out at 50%. So sometimes, as a first-time home buyer with, student loans, it may make more sense to go FHA. Also, FHA, it's really not that dependent on the credit score, whereas conventional is highly dependent on the credit score. So with the mortgage insurance premium, you're going to get a set rate you're going to get a set mortgage insurance premium rate regardless of what your credit score is. It doesn't matter if you're an 800 credit score or a 580 credit score, you're still going to have the same mortgage insurance premium. The mortgage insurance premium is typically it's 0.85% annually. So what they do is they'll take that and divide it by 12 to get the monthly mortgage insurance premium. The upfront mortgage insurance premium is 1.75%. So they'll finance 1.75% of the total cost of the loan. They'll finance that back into the loan amount. So the buyer actually walks away with less equity in the property. Yeah, this is just for the minimum. So if you do put a little bit more down, like if you do more than 5% down, you can see on the left-hand side there, they'll require less upfront, or if you do more than 10% down. But I guess the big caveat is that the mortgage insurance premium does never drop off, where with conventional, once you reach 20% equity, you are eligible to drop off that mortgage insurance. So your payment will go down much faster. With FHA, obviously, typically what your goal would be is to refinance into conventional loan to get that lower payment if you're then eligible. And obviously the fastest way to build up your credit is to pay your mortgage on time as well, because that has the biggest impact on your credit.
You may not know this, but is there any thought of changing that? I mean, typically people who get FHA mortgages are lower income, first-time home buyers. And it seems like they're at a disadvantage because they're funding this mortgage insurance premium forever, and their default rates were right in line with conventional default rates during, the mortgage meltdown in the early 2000s. So yes. Again, poorer people are paying the price.
Yeah, so I guess what did happen, the reason for that, it was not always this way. Before the mortgage meltdown, they were eligible to drop off their mortgage insurance premium, typically once they reach 25% equity in the property. But after the mortgage meltdown happened, they, basically they made it for the duration of the loan, because they essentially went bankrupt. HUD essentially went bankrupt, insuring all these loans during the mortgage meltdown. So, this is, I guess, they're doing so now in an effort to, if anything were ever to occur again, they would be able to cover themselves. So I guess if things continue the way that they are now, I guess they could potentially reinstitute that at some point. So I was going to touch a little bit on a Home Ready program, which Home Ready and Home Possible are two programs that are offered. They're two programs that are offered through conventional financing. They typically make sense for first-time homebuyers that are under that 80% area median income. But they have you'll typically you won't even know that your loan officer is actually using this program, but you definitely want to make sure that they are using it in that case, because the interest rates are typically lower for those programs, and they will also allow for non-occupant co-borrowers, so you can have somebody that's not living in the house be on the loan, as well as you're able to get gifts from family members, and they'll give you a discounted mortgage insurance for home ready programs as well. So yeah, so I guess this program is one of the only programs for conventional that'll allow you to do 3% down. You do have to meet their income requirements, which is the 80% area median income. Again, that's about $93,000 for whoever is on the loan for most of Maryland. It is over 100,000 in those counties that are bordering DC. You don't have to be a first-time homebuyer for this program. You can use non-occupant co-borrowers to help with the debt to income. You have flexible down payment assistance programs. And I guess really the only requirement is you have to be buying it as your primary residence. They will allow you to get up to 4 units with these properties, but you do have to put more down. You do have to do more down to have up to four units. Another program that you might want to use is the 203K, or we also have a conventional option as well. It's called the home style, but these programs are for, I guess, more of fixer upper properties. They'll allow you to, fix up the property and, I guess, finance the repairs of that property into the mortgage. So they separate it. And you can do all that by putting 3.5% down. Now, the 3.5% down is of the total, loan amount. So if you're financing $100,000 in repairs and it's $100,000 property, they're not going to allow you to do, $3,500 down. You're going to have to do the $7,000 for the $200,000 loan amount. They do separate it into 2 categories. They have the limited and the standard. The limited probably is a little bit more common just because there's really not as much involved in it, and it allows you to go up to $35,000 in your renovation costs. And it does allow you to do quite a bit of things. You can do I've had roof repairs, gutters. Yeah, you can do, like, I've had sidewalks repaired, garages sided, things of that nature. And you can also do stuff with septic and well. I've had people inquire about that as well. I guess the major benefit of the limit is you're allowed to live in the property. You can move in as soon as you close on the loan. For realtors, these are great products because you don't have to wait for all the repairs to get completed. What we do is we typically close on these in 45 to 60 days. They do take a little bit longer because we need to get a lot of documents from the contractors as well. That's just why they take a little bit longer. And then if you were doing the standard, there would be a HUD consultant involved as well. But we are able to close on the loan before any of the repairs start. So you don't have to wait 6 months for all the repairs to get finished to get paid. You're getting paid right after we close on the loan after that, after a typical 45 or 60 days. I've pitched these products to buyers a lot just because you can really, if you have a very picky buyer, they could potentially find a house that's, it looks fine, but it maybe isn't quite up to their expectations. And they could spend $35,000, making it their own. They can make it however they want it. They could completely remodel the kitchen. They can do anything to make the house how they want it to look. So you might want to keep this program in mind for more picky buyers. Even if they aren't necessarily looking for a fixer upper, they could fix up a house that, doesn't quite meet their standards to make it perfect for them. And I guess one of the major benefits of this program is that you can also, typically you will also get a lot of equity in the property by using one of these programs. It's typically not a dollar for dollar spend. So if you're spending $50,000 renovating the property that you bought for $200,000, you're going to be all in $250,000. But more than likely, the house is going to be worth at least $275,000 or $300,000. I don't think I can ever remember a time where the buyer was underwater in that case because of the renovation they did. I guess that's how, obviously, how flippers make all their money, is you can add more value to the house by doing the repairs than the actual cost of the repairs themselves. And these are eligible up to 4-unit properties. You can do the 3.5% down for up to a 4-unit. I had a close friend of mine did a 203K on a house out in Pittsburgh that was a 3-unit. He financed, I think, $25,000 or $30,000 in repairs, and he had 2 other units that are rented out, and they pay for his entire mortgage and a little bit extra on top of him living rent free. So for anybody looking to do house hacking, this is definitely a great program, because a lot of times obviously the duplexes and triplexes and quadplexes that you run into that are all fixed up are typically out of people's price range when they're first starting out. And you can use FHA or the 203K to get in, fix those up, and just put the 3.5% down. The 203K is not compatible with the Maryland Mortgage Program, but it is compatible with some of the other local down payment assistance programs. So for the standard program, this one just allows you to do a lot more structurally. They may upgrade you to a standard if there's, like foundation issues, or like, you need to get the whole roof replaced, or if it's just going to take a really long time. And then anything over that $35,000 threshold is going to fall into that category as well. So that's kind of more of your gut jobs, so to say. You would fall into the more standard 203K. I will say these are typically not used as end loans, because the interest rates are a little bit higher than them. So typically what we're recommending is, a buyer buys their house, gets into one of these programs, finances all the repairs, and then typically they'll either refinance to a conventional or a normal FHA program in the future. Has anyone used one of these programs in the past?
I have.
Did you find it to be a easy process, or?
Pretty much so. And I was advised to have people use the standard because of the consultant that oversees things. The hardest part was the client picking a contractor.
Gotcha. Yeah, I think that's typically the most difficult part is finding the contractors. You are required for both of these programs, you are required to get 2 competing quotes. The buyer can choose whichever of those quotes they want, but it can't be a family member of this. You can't, contract your brother to finance, to, fix up your home. And it also, you personally can't do any of the work on the property. So yeah, obviously the added layers to complexity are all the parties involved. Having the HUD consultant involved definitely adds another step. So I don't know if I would necessarily recommend getting them involved unless you absolutely need to, because they have to go out and inspect the property at multiple different times throughout the project. But again, it depends on what type of repairs you're getting. If you're getting, a complete, rehab of the property, you may want some, inspector coming out and checking on what the contractor is doing. If you're just, getting patches here and there and redoing the kitchen, that might not be necessary.
I found the buyers were always happy doing that kind of loan.
Yeah. We actually, my company has a whole team that specializes in these programs. I would still be like the loan officer on the file, but they oversee all of the contractor information. They finalize all the numbers. Because there's so many moving parts, it's great to have a team that specializes in these programs themselves, because it is so many moving pieces. It's hard to button everything down if you don't do this full time.
Can we see the page for the loan that you talked about before this?
The Home Ready one?
Yes.
Yep.
And does it have a direct link for us to access it, or should we just take a picture of it?
I think you could probably access this on so this is a Fannie Mae product, which is conventional. Okay. So you could probably if you just Googled Home Ready, it would probably give you a lot of information on it. Home Possible is basically exactly the same thing. It just comes from Freddie Mac, which is basically the other investor for conventional loans. I guess really the only difference is that Home Ready will sometimes allow us to go to higher debt to income requirements, whereas Home Possible is more lenient on the calculations for student loans. So you can kind of, depending on the borrower's situation, the interest rates are typically exactly the same. So it's more, who's more lenient for the income calculation and or the student loan calculation as to which one we choose. The USDA program is probably a program that not a lot of you have encountered, but it's definitely worth keeping an eye out for. There is a website where you can check. I literally just type in USDA property eligibility, and you can just Google whatever the address is to see if it's in a USDA eligible zone. Again, USDA is rural, so it's not going to be probably much in Baltimore City or Baltimore County. I don't really think there's a lot in Anne Arundel County, but if you are looking on the outskirts in like Frederick or up north, or definitely across the bridge, across the Bay Bridge in like Stevensville, like all of that area is USDA zoned, and that program will allow you to do 0% down. It's very similar to a VA loan, except for it does have mortgage insurance. It's at a reduced rate, but it does have that mortgage insurance premium, whereas VA, it doesn't have any mortgage insurance whatsoever. But yeah, they have a lot of great programs. I guess the big reason why USDA is sometimes difficult to use is because you're putting $0 down or 0% down. They do have stricter debt to income requirements. So sometimes people won't qualify for as much of a house as they were hoping for with that program. So that would be a reason why sometimes they would still utilize FHA, even if their house was zoned in a USDA zoned area. I guess as far as the down payment, I just want to make sure everybody's aware. You are able to use retirement funds for down payment. This is just, I guess you can always, I typically recommend against this unless they absolutely need to, but it is very commonplace in today's market to try to pull a loan or even a withdrawal from your retirement account. Typically, they can take up to 60% of the vested balance in there. So just because somebody has $100,000 in retirement funds, that doesn't mean that it's all accessible until after they're I think it's 60 years old, 59 and a half, but they can take a loan from it. And we actually, when they take the loan from it, we don't take the payment of the loan into account for the debt to income. So that is typically the best route to go if they are a little bit short on closing costs and they do have an IRA or 401k. Take a loan from it so they don't get hit with all the taxes, and then they can use that to get their mortgage payment to a point where it's comfortable. If a buyer does have cash that's in savings, or I guess it's in savings like at home in a safe or under their couch cushion, they will have to put that in their account for at least 2 months before it's eligible to be used as down payment. I run into this probably every single week. You would think eventually everybody would know, but it's definitely, people still think they can use cash for down payment. You need to, I tell them, immediately, you need to get this money into your bank account, or you could, potentially get a gift from a family member. But we are going to want to see that the money can be sourced. And obviously cash is not a sourceable way to make a down payment. And then you are able to get a gift from basically any family member as well. This has to be a gift. They have to sign a gift letter. Cannot be a loan that you're going to be repaying. We typically want to see 3 to 4 forms of documentation when we're getting a gift. We typically wait until after the loan has gone under contract to initiate things, because sometimes we can, cut out a few of those steps. If the buyer is getting a check written to them from a family member, what we will need to see is the bank statement of the gift giver. That's the most difficult thing to get, because they're like, why do you need to see my account? I'm not on the loan. But we need to see that they didn't put cash into their bank account. We need to see that money in their account is sourceable. We need to see that go, and then we typically will need to see a picture of the check, and then we'll need to see the bank statement of the buyer as well, see the money entering their account, and then we'll have both of them sign a gift letter that, states, what transfer took place. So it's kind of the whole stream is what we need to see. We can cut out some of those steps, especially with conventional loans. They have lesser requirements. If the gift giver wires the deposit directly to the title company, oftentimes we don't need to see their the bank statement of the gift giver themselves, and obviously there's no check to write down, so it's basically just the gift letter in that case, because we can verify that it has been transferred to the title company for closing. All right, well, that's really all that I have. Is there any other questions that I might be able to answer as far as the programs? Obviously, there's a lot more programs out there, but I think those are probably the ones that I encounter basically day to day in Maryland. There are other programs. If you're licensed in other states, there might be programs available there as well. We do a lot with the DC programs. If you happen to be licensed in DC, they have very similar programs to Maryland as well.
Thank you, Kyle, especially for the last part about the down payments. I guess I've been in real estate long enough that there was a time you could use up to 10,000 cash. So
they definitely did away with that. I don't know when they did away with that, but yeah, they do not want any cash. They want everything to be sourced. Any deposit over $500, the underwriter is going to be asking where that came from. So it can, and that goes along with educating your buyers as well. You want them to make it as little work as possible for them. So to at least do those deposits into other accounts that they're not going to use for their down payment might be the way to go, and just not to switch a lot of money between their accounts unless they absolutely need to, because otherwise we're going to have to ask for an explanation or even verifying document for each of those transfers.
Thank you.
Mm-hmm.
Thank you, Kyle.
Thanks for watching. We want you to come back because we know that you learned something from watching that particular video. That means you're going to subscribe and share with others what you learned from this particular platform. Welcome back on Friday to attend this live at 12 p.m. Eastern. Registration is found on our website, trainingwithbrenda.com or brendakasuva.com. Until next time, take care.